The story of Aston Martin is one of beautiful machines and near financial collapses, a cycle as familiar as the purr of its V12 engines. For decades, the company has operated like a master craftsman who can create breathtaking works of art but struggles to balance the books, constantly in need of a wealthy patron to keep the lights on. This historical pattern is now facing its greatest test as the entire automotive world shifts its gaze from the roar of internal combustion to the silent, instant surge of electric power. Electrifying a lineup is not like developing a new sports car. It is a financial undertaking of monumental proportions, requiring billions in research, development, and new manufacturing tools. For a small, perennially cash-strapped company like Aston Martin, this challenge is existential. The question is not just whether they can build an electric car, but how they can possibly pay for it. The answer to this question is unfolding now, not through a single magical solution, but through a multi-layered, strategic financial plan that is as intricate as the engineering in their vehicles. The first and most crucial layer of this strategy involves finding deep-pocketed partners who believe in the vision. For a long time, Aston Martin was like a brilliant but independent artist, trying to do everything on their own. This independence, while noble, was financially crippling. The turning point came with the arrival of a major investor, a consortium led by the Canadian billionaire Lawrence Stroll. His investment was more than just a cash injection, it was a strategic redirection of the entire company. But the real masterstroke in the financing plan was the decision to form a much deeper, technical partnership with a giant who had already spent billions on the very technology Aston Martin needed. This is where Mercedes-Benz entered the picture. Instead of Aston Martin spending its own limited money to invent an electric powertrain from scratch, a process that could take years and cost a fortune, they made a deal to access the technology Mercedes had already perfected. Think of it like this. Instead of building your own power plant, you simply plug into the grid and pay for the electricity you use. Aston Martin is, in a sense, plugging into Mercedes-Benz's electric grid. They get access to world-class electric motors, advanced battery systems, and sophisticated software, all while saving an unimaginable amount of money and time. This partnership is the cornerstone of their electrification finance. It reduces their research and development burden from a backbreaking weight to a manageable load, allowing them to focus their own capital on what they do best, designing the stunning bodywork, tuning the driving experience, and infusing the machine with that unique Aston Martin soul. However, even with a partner supplying the heart of the electric car, the body and soul still need to be paid for. This is where the second layer of the financial strategy comes into play, using the present to fund the future. The company cannot simply stop selling cars for 5 years while it develops an electric vehicle. It needs a constant stream of revenue to keep the business alive today while it invests in tomorrow. The leadership at Aston Martin understood that their most valuable asset was not a factory or a patent, but their name itself. The Aston Martin badge carries a weight of history, luxury, and desirability that few other brands can match. Their strategy, therefore, has been to aggressively monetize this brand in the short term to generate the cash required for the long-term electric shift. This means creating and selling more cars, but also more expensive and exclusive cars. We have seen a proliferation of special editions, limited-run models, and ultra-high-priced hypercars like the Valkyrie. These vehicles are sold in tiny numbers, but each one carries an enormous price tag and a huge profit margin. They are not meant for the average buyer. They are rolling works of art for billionaires, and the profit from each one sold acts as a direct deposit into the company's electrification fund. Furthermore, they are expanding their model range with cars like the DBX SUV, which has become a massive sales success, tapping into a lucrative market that provides a steady, reliable flow of income. Every DBX sold helps to subsidize the development of a future electric Aston Martin. It is a classic case of feeding the golden goose to ensure it lays eggs for years to come. Yet, even with a technology partner and a profitable present, the sheer scale of investment needed for a full electric lineup is so vast that a third financial layer is necessary, going back to the well of external funding. A company like Aston Martin, with its volatile history, cannot simply walk into a bank and ask for a multi-billion-dollar loan. Instead, they have to get creative in the world of high finance. This has involved a few key moves. First, there has been a concerted effort to clean up the company's balance sheet by restructuring its existing, and often burdensome, debt. By renegotiating the terms of old loans, they free up more cash for productive investment rather than just paying interest. Second, they have turned to the equity markets, essentially selling small pieces of ownership in the company to public investors. By issuing new shares, they can raise hundreds of millions of pounds in a single move. This dilutes the ownership of existing shareholders, but it is a necessary trade-off to secure the capital needed to survive and thrive. Finally, there is the potential for strategic, targeted investment from new partners, perhaps even from the geographic heart of the electric vehicle revolution, China. Attracting an investor from a region that is pouring immense resources into battery technology and electric mobility could provide not just cash, but also additional technical expertise and access to critical supply chains. This combination of debt management, equity sales, and strategic courting of investors forms the third pillar of the financial structure, providing the final massive infusion of capital required to cross the electric finish line. In the end, the financing of Aston Martin's electric dream is not a single transaction but a complex, interlocking system. It is a three-part harmony played on a global stage. The melody is the deep technical partnership with Mercedes-Benz, which provides the proven technology without the prohibitive cost of internal development. The rhythm is the aggressive commercialization of the current brand, using the profits from today's luxury and hypercars to pay for tomorrow's research and development. And the baseline, the foundational support, is the continuous effort to secure external funding from banks, public markets, and strategic investors. This is not the path of a tech startup with limitless venture capital, nor is it the path of a giant like Toyota or Volkswagen that can spend its own tens of billions. It is the path of a niche player with an iconic name, using every tool at its disposal, partnership, brand power, and financial ingenuity, to navigate the most expensive transformation in the history of the automobile. The success of this strategy will determine whether the next generation of silent, swift, and beautiful Aston Martins will ever grace the roads, or if the company's long story of financial peril finally meets a challenge it cannot overcome. They are betting their entire legacy that this multi-layered financial shield is strong enough to protect them as they march into the electric future.